Let's get in our special guest this morning. Mahesh Patil joins in to talk about how he's staring at the crystal ball into 2019. Mahesh, it's great to have you on the show. Thanks very much for taking out the time and stopping by our studios. Are you bullish about 2019, given that 2018 was not really the best year for returns?
Yeah, I think, 2019 again is going to be a year where you would see some improvement in the macro front. Okay, we've already seen that happen in the last 2 months. And the bottom-up story will continue to play out, right? So we've seen earnings will start to pick up in the last 2 quarters. I think that momentum should continue into CY19, and you should see fairly strong earnings growth coming in. Again, from a lower base. A lot of the sectors, like the banking sector, for example, okay, which has got depressed, should show a strong growth. And then the consumer sector and other sectors like the infrastructure and the construction should see a good recovery getting into the next calendar year. So I think looking at where the valuations are currently and looking at some of the macro headwinds on the global front, I would say 2019 would be a year where you could, one should be positive, but kind of moderate returns is what one should expect, because we are starting the year with not exactly very attractive valuations, right? I mean, you could argue that the PE multiples for the market are probably 10% higher than the long-term average, right? But earnings
18-19 times is stretching it?
Yeah, so I mean, long-term average multiples would be around 16 times PE multiple, right? So and the fact that we have elections, so I think in the initial period the markets could probably be range bound, but I think in the latter half, I think it could probably compensate for that and deliver decent. So I think one should expect fairly decent return, not too high a return. I think expectations should be more moderate going forward.
Sure, but when you're saying the markets in the second half will compensate for the election risk, you're pretty much, I believe, predicating that argument or that assumption, that expectation rather, on a clear mandate coming in.
No, not really. So what we're expecting is that irrespective of whichever government comes in, I think you should see the broader policy momentum, the impact of the policy measures which have been taken, the reforms. I think that should continue going forward. We don't see
even with the coalition?
Yeah, that should not impact. So we have seen that earlier also, right? Whatever momentum you have in the economy and the corporate recovery, that should not get impacted by the any kind of a government. We don't see any reversal of the reforms which has been taken. Obviously, the multiples could get impacted. Okay, if there is some instability on the political side, and that could be a temporary phenomena where the PE multiples could get impacted, and that's what we are already factoring in. So we're expecting some kind of a derating of multiples which could happen. And so that's about it. I think we've seen that earlier also in the past elections. Okay, whenever the results haven't been in line with expectation, markets have reacted initially, but in the subsequent months, okay, the markets have regained those losses. Okay, depending on the underlying fundamentals. I think that should really play out, and market over, post-elections, say 3-6 months down the line, I think the fundamentals will really catch up, and that's what will drive the market going forward.
And usually in the run-up to the elections as well, we do see a lot of activity coming. Okay, you mentioned that we are still 10%, in terms of valuations, we're still higher compared to what our long-term average is. So then, would you be still going out and vehemently buying into the market, or would you still say pick up in pieces or just nibble in here and there?
So while the PE multiples look higher than the long-term average, I would also like to emphasize that the earnings are still depressed, right? So compared to the long-term average, if you look at whether it is in terms of the overall ROE for the Nifty or profit as a percentage of sales, they are still at depressed level, almost at a 7-year, 8-year low. So on a lower depressed earnings, I think I'm still comfortable, market is still comfortable paying a higher PE multiple. I mean, over a longer term, that PE multiple could normalize, one could argue that, right? But in the near term, as the earning trajectory growth, as it tries to really come out from a depressed numbers, the growth numbers could be slightly better than even the long-term average. And that's what we are expecting. So if you look at the, even after the downgrade, after this quarterly numbers, I think the earnings growth for this year, okay, or more importantly FY20 is somewhere in upwards of around 20% kind of a growth.
What's the case you're making for higher earnings? Because we interacted with a lot of managements post the second quarter numbers, and they did say that those inflationary pressures are once again making a comeback, and some of them did have their margins and subsequently their profitability being impacted on account of those inflationary pressures. Revenue growth is of course a different thing, but what would you say would be a case for this 20-odd% growth that we're expecting in FY20.
So if we break down that growth component, the Nifty, the banking sector, the banking and financial services sector, which is got around 35% weightage, okay, so there the growth will be fairly strong. Again, it's probably can be called as a base effect, especially the corporate banks, the top 3 or 4 corporate banks. There the growth would be in excess of, I mean, number can be anywhere depending on how this year pans out. But clearly, I think those will be the key drivers for the growth. So if you remove the corporate banks, right, or the banking sector, then the growth will be around 14% or so, which is a more realistic, moderate number, okay, which one is expecting. And across the board, I would say I think as we move forward, we're seeing some momentum coming back into the capital goods sector. So the capital good companies are starting to show increase in terms of order book. I think post-elections you will see that momentum start to pick up in terms of order build-up, but also more important, execution before the election normally tends to pick up, and I think that should drive better growth over there. Consumer staples have been fairly good, I think, there, despite the increase in inflationary pressures. I think they should be able to maintain their margins. And I think the push by the government on the rural sides, looking at the recent elections, I think that should drive consumption fairly strong. So I think we expect strong numbers coming in from the consumer pack, which would drive the earnings, and then all the other sectors will contribute more or less in the low teens is what we would expect.
Anyway, SEBI's decision on allowing mutual funds to segregate distressed and illiquid assets on the one side, what do you make of it?
So I think it's a good move, and which is something which has been a long, the industry has been asking for it, because it takes care, especially during times of crisis, okay, where there are certain defaults on the existing book. I think we can quarantine and keep those assets aside, and that helps in terms of getting back new investors, because normally whenever there is kind of a credit issue on some of these credit funds, because of the underlying concern of the paper which is there in the portfolio.
So you remove it from the portfolio and just keep it in
so you keep it in a separate account. Yeah, so the existing investors who are there
So let's say ILFS, if somebody had an exposure to ILFS and some assets, let's say 100 crores, that from the AUM of the portfolio would be removed as capital.
And all the existing investors, okay, in the fund, okay, they will be given proportionate units in that separate account, right? So any new investors after that who comes in, okay, he will have a portfolio, okay, which is a kind of a cleanse from those toxic assets.
And what happens to that portfolio? Like how do you?
So that as and when the recovery happens in that, okay, because that portfolio will mark to market down, but okay, that doesn't mean that there will be losses on that, right? They'll have a normal resolution process which will go through, and whatever recovery happens in that portfolio, I think then that will be paid back to the investors, right? The existing investors who were there prior to the demerger of that.
You know, my colleague Siddharth made a very interesting point. He said that by that, if you allow that much and perhaps in a way encourage it, then you also not directly but indirectly have the fund managers
encouraged to take riskier.
I don't know whether encourage is the right word, but the accountability wouldn't be there. At the end of the day, we are paying a price to the fund manager to be diligent and to do his homework to get the right assets for investments, right? But if some of those assets go bad, doesn't it also kind of question the accountability that comes in for a fund manager?
No, I mean, there's no question about that. I think, by doing this, okay, what all you're doing is accountability and everything remains the same, right? The impact of that, what it will have on the existing investors, remains the same. It's only to ensure that new investors who are coming in, okay, are not really bogged down, okay, are concerned about the underlying assets. And normally we see
and
that
it does not impact the investor returns.
Yeah, or it impacts the redemption, because investors, okay, then want to we've seen that earlier, right? When these kind of crises happen, there is a pressure of redemptions, and there are no investors coming in because they are worried about some part of the portfolio, okay, which they don't want to have because of some concerns on the asset quality over there. So it takes care of that problem. Otherwise, I think in terms of the impact on the NAV, this remains the same as it is, right? What would have been earlier. So I don't think it really dilutes the whole process in terms of fund managers taking risk.
Their judgment call.
Their judgment call. I think this is the same. And again, it'll only be done in kind of a extreme situation, right? So I don't think we should be really worried about the fact that it would lead to fund managers taking additional risk or kind of diluting their whole process of due diligence. I think that's not going to happen.
Okay. Continuing with the SEBI board meeting, mutual funds can now invest in commodity derivatives. Do you think that's a market that's mature enough right now in India for you to even consider?
So I think it's still too early. I think one has to really look into it and see how one can really come out products around that and look at the kind of a depth which is there in that market. Okay, some of the derivatives, commodity derivatives are pretty liquid, but it's not across the board. So I think we'll have to work down and sit down and see, okay, how we can look at the opportunity, come up with products, okay, which can give some kind of a decent looking at the risk return and the volatility in that segment, okay, how we can structure this product, because again, these are products, okay, where every 1 month you have to roll it over, right? So one has to look at that kind of a risk also. We can't take a longer term view over there. So it's still too early, I would say, but clearly I think that's a segment which the industry will look into it and try to come out with some products down the line.
Okay. You spoke about banking, and I want to delve in a little more on that, given the fact that we have a new RBI governor, and he's obviously going to come out with some radical changes, apart from the fact that he's going to try and declog the communication channel with the government. But we have seen all of these PCA banks as well rally quite a bit, banks under PCA. At the same time, he's going to be keeping ease of liquidity as well as his priority, as he said yesterday during his press conference. How do you see the banking system change going forward from here on? You did say that banks are one of the sectors that is going to contribute majorly to earnings. In case of PSA norms as well are eased, liquidity norms are eased. How do you see the banking system change?
The banking system, even otherwise, I think we've seen the overall stress on the banking system which went through the NPA cycle having peaked out, and that would naturally start to kind of reflect in terms of the P&L and lower provisionings going forward. So that is anyways underway. Second important thing in the banking sector has been that with the challenges in the NBFC sector, we've seen the banking sector now coming in and trying to gain market share. The credit growth has been fairly strong. If you look at the credit growth number, has been around 14-15%. So I think that should help the growth for the banking sector, and also some improvement on the margin front, because some pricing power is coming back to the banking sector. You've seen the corporate bond spreads have gone up, right? And for the banks, the borrowing cost hasn't really gone up too much on the liability side, so there should be some margin improvement. And with the bond yields having eased off significantly, right, we've seen a 70 basis point decline over there. Some gains on the investment book, especially for the PSU banks, okay, which would come in pretty handy at this point in time when they're struggling in terms of profitability. So I think all these factors I think would lead to kind of an improved outlook for the banks. For the PSU banks, I think from the PCA banks, we don't know exactly how much relaxation would be there. But I think clearly if the government is able to introduce the capital infusion, okay, which they have talked about in the budget, I think that should be good. But I think PSU banks will also have challenges because market will be worried about farm loan waivers.
Yes.
Okay, so some of the governments have talked about that after the election promise in the recent state elections, and that could slightly weigh down on the PSU banking sector. But by and large, I would say the sector should see some relief in terms of improvement in terms of margins, the stress slippages ratio coming down, so that would provide some relief on the loan loss provisioning, and that should be good enough for most of the banks to really report strong earnings coming in from a very low base, especially for the corporate banks.
What would be your big election bet into 2019 as a theme?
So one would not like to bet anything on the elections because you don't know the outcome of that. But I think irrespective of the elections, I think we would look at themes, okay, which could play out irrespective of the election, right? And that's the best way to play, because betting on election outcome is not something which we would like to do on. So the broader themes would be the banking and financial services sector.
You already have 31% exposure there.
Yeah. So I think that's a steady. So we should see an improvement over there. But besides that,
where will you increase the exposure?
So I think the consumer space, consumer discretionary sector has seen a kind of a setback in the last 2 quarters. Probably because of certain concerns about, we've seen some consumer confidence getting impacted. The tight liquidity situation which was there, which kind of hurt in terms of credit available to that sector. I think those things will normalize, and I think the whole implementation of GST also has not been as great. I think in the post-election, I think you will see a more rigorous implementation of that. So the shift from unorganized to organized, which you expected to happen, didn't really happen to that extent. So that should benefit the consumer discretionary space going forward. So that's one sector. And again, something on the capital goods sector, I think, because capital goods sector, we are seeing capacity utilization levels move up. People are not still doing capex because they don't want to wait for the election outcome, right, before committing any large capex. So we think that should gain traction post the election. So these are the 2-3 sectors which one can look at positively. Again, irrespective of the election outcome, I would say.
I just want to take that point forward about consumption, which we were just in length talking about yesterday. I know you mentioned discretionaries, but I would just like to talk about the broader FMCG basket. Would you justify paying 50 and 60 times PE for a growth of 12 and 13% in FMCG, because that's what we've been seeing?
Yeah, so the consumer staples within that are looking fairly expensive on the PE multiples. And yeah, so there the returns could probably moderate down. So we're not really so much overweight on the consumer staples, right? As I said, it's more the consumer discretionary or the consumer durables and other retailing companies, which they're also expensive, but the growth rates could surprise positively going forward. On the consumer staple, I think it's more to do with, earning stability is there. Growth is still fairly healthy. I think rural growth has been fairly steady, and that's what is driving the other sectors. There are some concerns, but as the broader market starts to look better, I think some of these stocks could relatively underperform. So it's a question about absolute performance. The stocks could give absolute returns, but whether they can give you pretty larger returns, I think at these valuations, I think probably not.
That's exactly what Naveen and I were discussing yesterday.
Yeah.
What in this market can give exaggerated returns? Wouldn't you want to go with returns which are at best matching earnings, or
Yes.
well, even if they're at a discount to earnings, there is growth, there is that alpha coming in.
Yes.
Because I don't see in this, when the headline indices have not done much this year, can't really, I don't know how much does that really trickle down into specific stocks giving exaggerated moves. In this market, do you have to really play for outperformance, or do you have to play for just performance?
So, I think you're right. Probably the headline market returns would be more moderate. That's what, looking at the overall macro concern. So it should be more of bottom up, right? And companies, in our view, is that with steady growth, I think the returns are not very high. I think we're not really targeting companies, which can give you exaggerated returns or multi-baggers. It's more of protection on the downside, and a steady return is what is the current situation, because there are a lot of challenges which are there. Globally, domestically, let's say elections, while we're not worried about it, but it can have its impact. Sure. So whether the earnings visibility, steady earnings growth, and more moderate returns, but predictability is much better. I think that's where I think one should be focusing on. There are stocks and sectors which are pretty depressed and in terms of valuations. One can even look at those. I think when some stability comes back into the market, when the confidence comes back in the market, I think there you could get probably potentially oversized returns, because the valuation is depressed, and if you're able to get a P re-rating, that's where you make the multi-returns. But I don't think one should really expect that over the next 6 months, right?
I don't think that's possible. There are too many headwinds in the market right now to expect supernormal returns. I think normal returns is something we can go by with.
Sure.
Okay. Mahesh, thanks very much for joining us and speaking with us about the markets this morning. Really appreciate your views.
Okay, that was of course Mahesh Patil, consumer discretionaries. We also have banking and financials and capital goods among something that he's flagging off that could be wealth creators in the year to come by. But the top 5 losers of the Nifty